What happens when America's closest ally becomes its biggest economic enemy? The answer is unfolding right now, and it's reshaping the global financial system in ways no one saw coming. While Canadians are boycotting American whiskey, dumping their Tesla stocks, and canceling family trips to Disney World, they're simultaneously pouring $9.2 billion into U.S. government debt in just 1 month. That's the biggest surge since November, happening at the exact moment when anti-American sentiment in Canada has reached levels not seen since the War of 1812. Meanwhile, 50% tariffs are crushing entire industries on both sides of the border, and two world leaders have just agreed to a 30-day deadline that could either save the longest undefended border in the world or trigger the most devastating economic warfare between allies in modern history. This isn't just another trade dispute. This is the moment when the economic order that has governed the world for 80 years either adapts or breaks completely, and it's all happening because of what went down in a 70-minute meeting between Donald Trump and Mark Carney in the Canadian Rockies. As Canadians boycott American whiskey, dump Tesla stocks, and cancel trips to Disney World, they're simultaneously buying billions in U.S. government debt. It's the economic paradox that's baffling Wall Street and breaking every rule economists thought they understood about global finance. In April alone, while anti-American sentiment in Canada reached fever pitch, Canadian investors poured $9.2 billion into the U.S. Treasury securities. That's the largest monthly surge since November, happening at the exact moment when the Sell America trade was supposed to be at its absolute peak. We're talking about a month when Trump's chaotic tariff rollout sent American stocks, bonds, and the dollar into a tailspin, yet somehow Canada's appetite for Uncle Sam's debt actually increased. But here's where it gets even stranger. Despite buying all that American debt, the total value of Canada's Treasury holdings actually plummeted by $58 billion in that same month. Think about that for a second. They're buying more, but their investment is worth less. It's the biggest swing for any of the top 20 foreign owners of U.S. debt, and it perfectly captures the insanity of what's happening in global markets right now. To understand why this is so shocking, you need to know about what used to be the golden rule of international finance. Since the end of World War II, when America emerged as the unrivaled global superpower and created the dollar-based world trading system, there was one thing you could always count on. In any crisis, anywhere in the world, investors would rush to the safety of United States assets. Political upheaval in Europe, money floods into U.S. treasuries, war in the Middle East, the dollar gets stronger, economic uncertainty in Asia, American bonds become a safe haven. This wasn't just market behavior, it was the foundation of American financial dominance. It meant that no matter what America did, no matter how much debt it accumulated, no matter how controversial its policies became, the world would always need dollar assets. It was the ultimate insurance policy for American economic power. That rule is now broken. Despite a major war breaking out in the Middle East just last week, the dollar continues weakening and U.S. bond yields are climbing instead of falling. Instead of rushing to American assets, investors around the world are rushing to buy gold. The precious metal has now overtaken the euro as a reserve currency, claiming 20% of global reserves compared to the dollar's 46%. Central banks that used to automatically buy more treasuries are now actively diversifying away from them. And at the center of this seismic shift is America's closest ally, Canada, whose investment behavior is telling us something profound about the future of global finance. When your best friend starts hedging their bets against you, even while they're still lending you money, you know something fundamental has changed. The Canadians aren't just angry about tariffs. They're preparing for a world where America is no longer the automatic safe haven it once was. What we're witnessing between Trump and Carney isn't just a trade dispute. It's a masterclass in economic warfare, where every move triggers a countermove, and the stakes keep escalating with each round. This is chess played with entire industries as the pieces, and millions of jobs hanging in the balance. Trump fired the opening shot back in March with 25% tariffs on Canadian steel and aluminum. Now, if you're thinking that sounds familiar, you're right. Trump tried this playbook during his first presidency, but this time he's going much further. By June, he had doubled those tariffs to 50%, effectively making Canadian steel and aluminum twice as expensive overnight. But that was just the beginning. Then came the 25% tariffs on Canadian automobiles, hitting an industry that employs hundreds of thousands of people on both sides of the border. And underneath it all, Trump imposed a 10% baseline tariff on most goods coming from Canada, turning what used to be the world's longest undefended border into an economic wall. To understand the scale of what Trump unleashed, consider this. Canada ships over 90% of its total steel and aluminum exports to the United States. They consume about a fifth of America's steel exports and 50% of its aluminum exports. This isn't just trade, it's economic integration built over decades. Trump wasn't just imposing tariffs, he was taking a sledgehammer to the foundation of North American economic cooperation. But Mark Carney didn't just sit there and take it. The former central banker who ran both the Bank of Canada and the Bank of England knows how to play hardball in global markets. His response was swift, calculated, and designed to hit Americans where it hurts most. Carney slapped $30 billion worth of retaliatory tariffs on American goods, but he didn't pick these targets randomly. This was precision economic warfare. Orange juice for your morning breakfast? 25% more expensive if it comes from Florida. That Harley Davidson you've been eyeing? Same markup. Wine from California, beer from Milwaukee, coffee beans, appliances, footwear, cosmetics, even paper products. Carney made sure that ordinary Americans would feel the pain of Trump's trade war every time they went shopping. The genius of Carney's strategy wasn't just the breadth of products he targeted, it was the psychology behind it. He picked items that Americans use every day, brands they recognize, products that would make them ask their representatives why their morning orange juice suddenly costs more. But Carney's masterstroke was what he called Buy Canadian procurement rules. Under these new regulations, Canadian producers and trading partners who have tariff-free reciprocal access can compete for federal procurement of steel and aluminum, while American companies are effectively locked out. Canada is about to embark on a massive infrastructure building spree under Carney's leadership, doubling housing capacity, building new defense installations, constructing oil and gas pipelines. All of that requires tons of steel and aluminum, and now American companies won't be able to compete for those contracts. Then came the ultimatum that changed everything. July 21st. Carney announced that Canada would adjust its existing counter tariffs on U.S. steel and aluminum products to levels consistent with progress made in broader trading agreements with the United States. In diplomatic language, that's essentially saying, make a deal with us by July 21st, or we're cranking up the economic pain. Here's what that means in practical terms. While the Federal Reserve has kept interest rates steady throughout 2025, the Bank of Canada has slashed rates by 225 basis points over the past 9 months, including cuts in January and March. As markets closed on Friday, the 10-year U.S. Treasury yield was sitting at 4.38%, while Canada's equivalent was at 3.30%. This interest rate divergence is creating a fascinating dynamic. Higher interest rates in the U.S. make American Treasury bonds more attractive to Canadian investors, which helps explain why they keep buying U.S. debt even while their governments are locked in a trade war. Canadian investors can earn more than a full percentage point higher return on American bonds, provided they can effectively hedge against currency risk from a weakening U.S. dollar. But this also reveals the deeper economic strategy at play. While Trump is using tariffs as his weapon of choice, Carney is playing a more sophisticated game. He's using Canada's monetary policy, procurement rules, and strategic tariff placement to gradually decouple the Canadian economy from American dependence while still taking advantage of higher U.S. interest rates for Canadian investors. The most telling moment in this entire economic chess match came when Carney established what he called tariff rate quotas, setting them at 100% of 2024 levels on imports of steel products from non-free trade agreement partners. This seemingly technical move is actually revolutionary. Carney is essentially creating a fortress around Canadian steel and aluminum markets, ensuring that even if global trade becomes chaotic, Canada can stabilize its domestic market and prevent what economists call harmful trade diversion. What we're seeing isn't just two countries arguing over trade terms. This is the methodical deconstruction of the most integrated economic relationship in the world, with each side trying to inflict maximum pain while protecting their own vulnerabilities. And with every move, the stakes get higher, the positions get more entrenched, and the possibility of a peaceful resolution gets more complicated. For the first time since World War II, a major war breaks out in the Middle East, and investors don't rush to buy American dollars and treasury bonds. Instead, they're buying gold. This isn't just a market blip. We're witnessing the cracking of America's financial foundation, and it's happening faster than anyone expected. The numbers tell an incredible story. Gold has quietly overtaken the euro to become the world's second largest reserve currency. Central banks now hold 20% of their reserves in gold, compared to just 46% in dollars. That gap used to be insurmountable. Now it's closing rapidly, and the trend is accelerating. Since late March, foreign central banks have dumped $48 billion worth of U.S. Treasury securities from their Federal Reserve holdings. Bank of America's strategists are now warning that visible cracks in foreign demand for American debt are appearing. This is the kind of shift that reshapes centuries. The cause isn't some external shock, it's coming from within. Donald Trump's presidency has systematically undermined confidence in U.S. assets through erratic policymaking, on-again, off-again tariffs, and threats to default on debt or tax foreign investments. The decline of the dollar has almost perfectly tracked his second presidency. America's most powerful tool of global influence is being weakened by its own leadership. John Rapley, an expert who's studied the rise and fall of empires, has distilled this moment into a simple strategy for countries like Canada: buy gold, sell oil, and get building. It's not just investment advice, it's a roadmap for navigating what he calls the emerging post-dollar world. But here's where the story gets even stranger. Oil prices should have spiked dramatically with war raging between Israel and Iran. Instead, they've barely moved, rising only back to levels we've seen over the past 3 years. The old pattern is broken because the world's energy landscape is shifting beneath our feet. China's demand for fossil fuels is now expected to peak in 2027, years ahead of previous forecasts. Across the developing world, the energy transition is proceeding faster than anyone anticipated. The volatility of oil and gas prices has become a major drawback compared to the stability that renewable energy offers. For Canada, this creates a fascinating paradox. They're likely to enjoy a short-term windfall from Middle East instability because they're a safe, reliable supplier when U.S. oil production may have peaked. But any country treating this as a return to the oil boom days would be making a historic mistake. The smart money is using any energy windfall to build new industries for a world that's rapidly moving beyond fossil fuels. We're watching two empires decline simultaneously: America's financial dominance and oil's energy dominance. The countries and leaders who recognize these shifts first and adapt fastest will write the next chapter of global power. Those who don't will find themselves clinging to the wreckage of the old world order. Mark Carney isn't just responding to Trump's tariffs. He's executing what might be the most ambitious economic independence strategy Canada has ever attempted. The numbers reveal just how dependent Canada has become on its southern neighbor. 90% of Canada's steel and aluminum exports flow directly to the United States. That's not trade partnership, that's economic vassalage, and Carney knows it. His strategy is audacious in its scope. While Trump's erratic policies are driving global investors to seek alternatives to American markets, Carney is positioning Canada as the stable, predictable alternative. European officials are already close to signing defense procurement agreements with Canada, specifically designed to reduce dependence on American military equipment. This isn't just about diversifying suppliers, it's about building parallel systems that bypass American control entirely. Carney's stated goal sounds almost impossibly ambitious, making Canada's economy the strongest in the G7. But when you consider the context, it starts to make sense. With Britain consumed by post-Brexit uncertainty, France and Germany dealing with political instability, Japan facing demographic collapse, and Italy struggling with chronic economic problems, Canada might actually have a realistic shot at this goal. The window of opportunity is narrow, but it's real. The challenge is that Canada's current economic structure makes this transformation incredibly difficult. Nearly 3.6 billion Canadian dollars worth of goods and services cross the US-Canada border every single day. Canada is the top export destination for 36 American states. This isn't a relationship you can simply restructure overnight without massive economic disruption. Global investors are actively looking to diversify away from American assets, and American entrepreneurs and academics are genuinely considering relocating due to political uncertainty. Canada has a singular opportunity to capture this flight of capital and talent. The question is whether they can build the infrastructure and remove the regulatory barriers fast enough to take advantage of it. This brings us to one of the most perplexing aspects of the current negotiations. How exactly does a new bilateral agreement between the United States and Canada fit within the existing United States-Mexico-Canada agreement? The USMCA is scheduled for review in 2026, just around the corner in trade agreement terms. Trump has always preferred bilateral deals over multilateral ones, viewing them as easier to control and renegotiate. But you can't simply extract one country from a trilateral trade relationship without affecting the other two. Mexico finds itself in a particularly awkward position. They're watching their two USMCA partners negotiate a separate deal that could fundamentally alter the North American trade landscape. If the US and Canada reach an agreement that gives Canada preferential access or treatment, Mexico could find itself isolated and disadvantaged. The ripple effects could destabilize the entire North American economic integration that took decades to build. The USMCA review was always going to be contentious, but these bilateral negotiations add a layer of complexity that nobody anticipated. Are we looking at the gradual dissolution of trilateral North American trade in favor of a hub and spoke system centered on the United States? Or is this bilateral deal meant to serve as a template for a broader renegotiation of USMCA? The uncertainty itself is becoming a factor in how businesses and investors make decisions. Meanwhile, the foundation of American economic power continues to erode in ways that most people don't fully grasp. Foreign investors control roughly 30% of the entire U.S. Treasury market. That's not just a statistic, it's the bedrock of American financial dominance. When foreign central banks and private investors hold nearly a third of your government debt, they're essentially funding your entire governmental operation. The April data revealed a troubling split in foreign investor behavior. Private foreign investors were net sellers of long-term U.S. debt, while only government institutions like central banks and sovereign wealth funds remained net buyers. This suggests that market-driven investors are losing confidence faster than government entities, which often hold treasuries for strategic rather than purely economic reasons. Bank of America's credit strategists aren't mincing words anymore. They're openly discussing visible cracks in foreign demand for U.S. debt. When major financial institutions start using language like cracks to describe Treasury demand, that's not subtle market commentary, that's a warning about systemic risk. The trend becomes even more concerning when you consider that central bank holdings at the Federal Reserve have declined by $48 billion since late March. These aren't day traders making quick decisions. These are the most conservative, stability-focused financial institutions in the world, and they're reducing their exposure to American debt. For Canada, this creates both opportunity and risk. If foreign investors continue fleeing U.S. assets, Canada could capture a significant portion of that capital. But if American financial instability spreads, Canada's deeply integrated economy won't be immune to the consequences. Carney's bet is that Canada can decouple fast enough to benefit from American decline without being dragged down by it. The next 30 days will reveal whether this gamble pays off or whether Canada finds itself caught between an ambitious independent strategy and the reality of continental economic integration. The implications stretch far beyond the immediate economics. Trump is essentially using Canada as a laboratory to test whether his America First approach can coexist with traditional alliance relationships. If he can force Canada, America's closest ally and most integrated trading partner, to accept terms that clearly favor American interests, it sends a powerful signal to every other nation about what they can expect from this administration. For the other G7 nations watching from the sidelines, the Canada negotiations have become a crucial indicator of American reliability as a partner. Japan and the European Union are still scrambling to reach their own deals before Trump's July 9th deadline. They're studying every detail of how Trump treats Canada because it previews how he'll treat them. If America's most cooperative neighbor can't get a fair deal, what hope do they have? The scenario planning reveals just how consequential these next few weeks could be. In the best-case scenario, we see mutual tariff elimination and enhanced security cooperation that actually strengthens the North American partnership. This would demonstrate that Trump's transactional approach can produce win-win outcomes and might encourage other allies to engage more directly with his administration's demands. But the escalation scenario is genuinely frightening in its implications. If talks break down and we see tit-for-tat tariff increases, the supply chain disruptions would ripple through both economies within weeks. Canadian steel and aluminum workers would face immediate layoffs, while American manufacturers dependent on Canadian materials would see their costs spike dramatically. The integrated North American auto industry, which relies on components crossing the border multiple times during production, could face serious disruption. Perhaps most likely, though, is the stalemate scenario where neither side gets what they want, but both sides claim victory. We'd see managed tension with gradual economic decoupling as both countries slowly reduce their dependence on each other. This might be the most dangerous outcome of all because it would happen slowly enough that most people wouldn't notice until the damage was irreversible. The broader global pattern makes Canada's situation even more critical. Trump has already demonstrated that he can make deals when he wants to. The UK secured a trade framework that protects them from some tariffs while maintaining the 10% baseline. That deal was clearly influenced by Brexit dynamics and Britain's desperate need for post-EU trade relationships, but it proves Trump is willing to negotiate when he sees advantage. China managed to reach what officials are calling a tariff truce, though the details remain murky, and the agreement hasn't been formally approved by both Trump and Xi Jinping. Still, the fact that the world's two largest economies found a way to step back from the brink suggests that even the most contentious trade relationships can find temporary stability. Japan and the European Union represent the middle ground. They're actively negotiating, with European Commission President Ursula von der Leyen describing the talks as complex but advancing. The goal is still a deal by July, but the complexity suggests these negotiations are far more difficult than the UK's relatively straightforward arrangement. This is what makes Canada such a fascinating test case for alliance management in the Trump era. Unlike the UK, which needed America more than America needed Britain, Canada and the US have genuinely mutual dependence. Unlike China, which represents strategic competition, Canada is supposed to be America's closest ally. Unlike Japan and the EU, which are dealing with Trump as outsiders, Canada shares a continent and has the deepest economic integration with the United States. If Trump can't find a way to make his transactional approach work with Canada, it raises serious questions about whether his foreign policy can maintain any meaningful alliances at all. Conversely, if Canada can't find a path forward with an administration that at least claims to value deal-making, it suggests that the era of predictable alliance relationships may be over, regardless of who occupies the White House. The stakes go beyond economics or even politics. We're watching a real-time experiment in whether the international system built after World War II can adapt to leaders who view every relationship as a zero-sum transaction. Canada's experience over the next 30 days will likely become a template for how middle powers navigate an increasingly unpredictable American foreign policy. The outcome will either demonstrate that Trump's approach can strengthen partnerships through tough negotiation, or it will confirm the fears of allies worldwide that American reliability is now a thing of the past. Either way, the reverberations will shape international relationships for years to come.